and Lee, delighted to have you here at this pivotal moment in Canada's economic history. Thanks for joining us.
Thanks for having us.
Yeah,
Happy to be here.
great to have you both. Okay, well, I was listening to it yesterday, and I thought it was, in terms of what they said, actually wasn't that interesting, which it usually is. Sri, what did you think?
Yeah, I mean, I would agree. I mean, the statement was pretty much in line with expectations. The market had already priced in the 25 basis point cut, and they pointed to all the kind of reasons around the uncertainty around tariffs. At the press conference, there wasn't really a lot new that was added beyond what was in the statement, other than I'd say the only big takeaway that we came away with was that he did acknowledge that the Bank of Canada sees the current rate at neutral. And we know that that's a range, and they're right in the middle of that range right now. And so we acknowledge that they've kind of reached their neutral rate. So any additional movement in the rate would really depend on their outlook going forward on the economy.
Okay, interesting. Lee, boring is beautiful these days, to be perfectly honest. Nothing wrong with boring, but maybe your comments on that as well.
Yeah, I mean, we could use some boring right now.
Yeah.
That is for sure. Yeah, I mean, basically they cut rates because of the uncertainty.
Yeah.
That's that, full stop. They put in a separate. They released a survey of consumers and businesses, and that was really the driving force behind the reason to cut yesterday.
Yeah, interesting. Okay, so let's go straight to that. We'll actually come back to the neutral and maybe terminal in a minute. But Sri, on the sentiment side of things, this is where you sort of it's interesting how you put a value on this. If one day, fiscal policy has to come in to sort of pull us out of our real anxiety concerns about the tariff war and the sort of looming threat. But I mean, sentiment is not great. Why did they release that now? They don't normally release that now. Is that correct?
Well, usually they would tie in that these survey results and details when they do their monetary policy reports, which the next one's scheduled in April. And so they even in the press conference, they called out that they released these results earlier than they normally would have. And the thing is, you have to remember, if you go back to the last Bank of Canada meeting, they pretty much signaled that they were where they wanted to be, that any future changes in rates would really be dependent on something shifting. And obviously, we've had that shift in terms of the trade policy and trade wars that have been in the market. And if you just look at the Canadian economy, growth was better than expected in the fourth quarter. Job growth was solid up until last month. And so all of those would point to an economy that's responding to the rate cuts that the Bank of Canada has put in place over the last year. And but what has changed now is the sentiment, and we're seeing consumers start to save more, not really looking at spending. You've seen businesses cut back on investment. Hiring intentions have started to come off a little bit from companies because of the uncertainty. So all of those have the potential to impact the economy going forward and leading to a slowdown. And if you look at the where a trade war hits the most, there's 43, I believe it's 43% of Canadian exports are related to small to medium businesses, small to medium enterprises. 1 in 6 workers is affected by impacts to exports. And so all of these things come into play for the future outlook of the economy. And this uncertainty is really what could potentially feed into a slowdown. And that's why the Bank of Canada really took out more of an insurance cut this time.
So take that forward for us, Lee, because you've got the Bank of Canada doing essentially what it can, and there's a fair amount it can't do. The 1 in 6 affected by a trade war in Canada, this is sort of a discussion of, could fiscal policy fix that? Could it save us from going into recession, for instance, if we seem to get closer to that sort of situation? Like, the central bank has done what it needs to do. Who helps the people who are hit by the trade war? That becomes a question of fiscal policy.
Yeah, I mean, so Macklem spent a good bit of time yesterday talking about how monetary policy is a blunt instrument, can't fix all of this. We're going to need help on the fiscal side. So, you could see a resumption of unemployment insurance benefits. And then, one of the major things that's out there right now is a discussion of reducing inter-provincial trade barriers. And that could be you're not supposed to waste a crisis, right? So this is an opportunity for Canada to break down those inter-provincial trade barriers. The IMF had a report out that they were saying that you could see a positive hit to growth of around 4%. That would be pretty amazing if you could see that, and that's nearly $3,000 per capita if you break down into provincial trade barriers. So that is something Canada can do to respond to this in the very near term.
Those are much better numbers than I've heard from other types of reports. I mean, so 4% upward hit to GDP if those barriers come down. Wow.
Yeah.
On a per capita basis.
On a per capita basis. Yeah. That's amazing. One of the things in the press conference yesterday that I noticed is, and I don't know if everyone was grappling for questions because they didn't know to ask, but there was quite a lot of focus on the currency. And one of the other things that has been, resilient might not be the right word, but less of a falling off a cliff than perhaps some had expected is actually the Canadian dollar. Sri, did you notice all those questions and sort of the thoughts of why it's been okay, actually, the dollar, considering?
Yeah. It was interesting that people always try to ask questions around the currency because the bank has been pretty steadfast in terms of not commenting on the sort of the impact of their policy on the dollar, and they'll claim that it doesn't come into their sort of decision making, even though
you just said claim, right? You said claim.
Yes.
Yeah, because in fact, if they hit the button hard enough, the currency
right. I mean, they have to care about it because ultimately it does have an impact on how the economy, what happens in the economy, and so on. They will tell you they don't target it, but obviously, if you have an extreme move in the currency and that has repercussions for the economy, they're going to have to respond. So, but yeah, I mean, I think the general view is that because of the impact of tariffs to Canada, that the currency should come under much more pressure. And if you compare it more recently to other global currencies outside of the US dollar, it actually has underperformed because Canada has been sort of more front and center in sort of the trade wars. But at the end of the day, if you think about the underlying economy and what's been going on in Canada, there's actually been some strength, and that's actually been what's probably been supporting it on the other side. And so, up until recently, the weakness in the dollar was more of a U.S. dollar, strong U.S. dollar phenomenon, as opposed to Canada on its own weakening. But obviously, more recently, it's been more specific to Canada relative to other currencies. But the strength of Canada and the economy, if you took the trade uncertainty aside, people could argue that the Canadian dollar is actually undervalued right now. And so I think that's kind of been an offset for the weakness due to trade-related pressures. We also have to keep in mind that the currency has weakened quite a bit over the past year as well.
Right. Anything to add to that, Lee, specifically before I move on a bit?
I mean, I just Shree's last point at the end. I think that's so. Focusing on the near-term moves, it's been relatively stable versus the USD. However, it has depreciated a lot, and all of that is due to interest rate differentials.
Right. Yeah, which have been widening, as we know. So they still have lots of room to cut if they needed to. The Bank of Canada does. I mean, there's a cushion there, which in some ways is reassuring, certainly. I mean, we're not at 0% interest rates, as was sort of closer to the story a few years back. But to what extent is that cushion should give us some security, actually?
I mean, there's still 275 basis points left before they need to get to extraordinary measures. So that's helpful. That's they've got that in their back pocket, and that's frankly part of the reason that, coming out of the pandemic, that all central banks wanted to raise rates again, so that if they saw another downturn, that they had room, so that they wouldn't have to just rely on QE and other measures. So there's a lot of scope for the bank to cut to the extent it's necessary.
Let's talk about the bond market itself. There's actually another eco point that came in to the US this morning, and it's just mostly about how the bond market is reacting to what appears to be just less inflation, deflation is happening, disinflation anyway. What would you say about the overall inflation picture right now, and how any of us need to react to it? I'll put that to you, Sri.
Yeah, it's an interesting question because there's a lots of puts and takes right now. We've obviously come off of some very high inflation numbers over the past couple of years, and we're getting into more of a sweet spot of where central banks want to be. But the issue, I think, and we have seen softer numbers in the US definitely. In Canada, things actually turned up a little bit more recently. But if you think about it more broadly and look at the details, there is still some components that are leaving inflation somewhat stickier, and that means the last leg of getting to a target is going to be a little more challenging, and so I think that that's definitely an element to think about. And then obviously you add in trade war uncertainty and tariffs, and even though those might be seen as a one-time shock, at some point, they are still going to feed into price increases in the near term. And then with that comes inflation expectations, and that's really what starts to lead to spiraling and sort of wage price spirals and so on. And so if expectations for inflation start increasing due to tariffs, then that's a feedback loop that the central banks are going to want to sort of stop as quickly as possible.
Lee, let me ask you to comment on that because, as you say, it's sort of the ongoing, it's the persistency of the tariffs that would bake itself into the expectations. I know that you don't have probably any of us have any special insight into where this is all going, but can you just give us your thoughts on the persistency of how this goes?
Yeah. So the timing obviously is not great. So inflation has come down. It's at target for the bank. But Sri talked about core measures that are still above. So 3-month annualized average core is around 3% right now. It came down from 3.5. So that's still elevated. A tariff shock that is persistent, as you're talking about. Macklem talked about this a few weeks ago, that it will raise prices by 40 to 60 basis points, nearly 0.5%. And that's a permanent shift up in prices. And then the concern around that is, do we then see that feed into consumer expectations? That's then you get a wage price loop, price wage loop, however you want to say it. But if consumers are expecting higher prices, it feeds into itself, and it has this self-realizing phenomenon where it can persist. And that's the thing about which the bank is probably most concerned. However, the bank is also talking about a shift down in GDP. So if you see prices go up and GDP come down, that's probably not persistent, but it will depend on what kind of fiscal response we see. So if animal spirits are out there and strong, then that can, if we see a really strong fiscal response, then that can lead into more persistent inflation.
Right.
So it's a balancing act.
It's a balancing act. Sri, just remind us before we go into some of the actual asset classes that are of interest to you right now, just the position of the Canadian bond markets, generally speaking. Canada sometimes likes to tout that it has lower deficits and debt than other G7 counterparts and so on. But just sort of remind us of the case for Canada, probably what it was 3 months ago, and then we'll get into how different it is now. But
yeah, I mean, in terms of the bond market, Canada obviously has been in a good position financially relative to the rest of the G7, which you mentioned. But I do think the concern going forward is potential deficit spending and increases in deficits. And you're starting to see that at the provincial level. You will likely see a federal response once we have a new government in place or over the next few months. And all of those factors do come into play. That being said, Canada's in a position of strength. It has room, it has fiscal capacity, and we saw it, during the pandemic, for example, right? Canada everyone talked about how aggressive the spending was, and we've recovered fairly well from that, and it proved to support the economy. And I think in this instance, the Canadian the fiscal sort of positioning lends itself to availability of the government stepping in and helping out sectors that are hit hard. But what will and I don't think anyone anticipates you need pandemic type support in this case. And so we've shown that we do have the fiscal capacity, and that's going to be supportive as well.
Let's go into sort of what you are finding in terms of, you mentioned provincials there, the position of them, in terms of deficit spending. I mean, how attractive are some of the provincial bonds that are issued? Lee, let's go to you on that. I remember not so long ago, you talking quite a lot about provinces funding themselves internationally, actually, as well. So maybe just pick up on the provincials for us.
Yeah, that's right. So, we like provincial spreads, especially relative to longer dated, high quality corporate bonds. The spreads are relatively tight between the two, so we'll see provincials as much more defensive going forward. But as you point out, to the extent that we do have a downturn, you'd expect provincial spending to increase. That means more supply in our market. More supply tends to bring spreads wider. Having said all that, we've watched the provinces through the pandemic and other challenging times. They will diversify their funding sources. So if we normally expect to see about 100 billion in provincial Canadian dollar provincial debt issued each year, and when it spikes to during the pandemic around 150, much of that excess, so that's probably 40 of the 50 billion, was funded abroad. So in the U.S., in euros, in sterling, even in Aussie dollars. So you're seeing the provinces fund themselves elsewhere, and that takes a lot of the pressure off of spreads for us.
Right. That's really interesting. Sri, anything else so defend a more defensive side of the portfolio for you right now, the provincials?
Yeah, definitely. I mean, it's again, it's like you could point to the fundamentals, as Lee mentioned, and that there will be increased spending and increased borrowing. But if you think about just valuations relative to other sectors like the corporate sector and long utilities, for example, those spreads are very compressed. The government sector is always going to be much more defensive in a period of volatility. And so it's a good place to still generate incremental yield but still somewhat be defensively positioned in a portfolio when you have this kind of volatility. And if you go into the corporate space, on a similar note, we do have credit exposure. When you have this kind of volatility, you do expect spreads to widen, and we have seen that happen of late. But we're focused on more broadly being in defensive sectors, and for Canada, that tends to be the banking sector. Even though you can argue that banks will get hit and growth will come down, that's probably more of an equity story than a credit story. The banks are well capitalized; they're the bellwethers in the Canadian market, and they provide, and they're very liquid. So, and not to mention that they tend to issue shorter duration maturities, and so we like short, intermediate credit versus long corporates because you have a lot more cushion against volatility embedded in the spreads. And so I'd say provincials and financials are probably where we have most of our spread exposure in our portfolios right now.
Really interesting. Lee, just kind of back to maybe adding on to what you were saying about provincials. This is a question coming in. What are your thoughts on Canada's US dollar global bonds? So more at the federal level.
You mean the bonds that were just issued recently?
Yeah.
Yeah. So I mean it's something Canada does on a periodic basis just to help fund themselves. Over time, you often see a strong demand for Canadian dollar bonds issued in USD. Global money managers like reserve funds, they like to diversify away from treasuries. So there's usually pretty strong demand for Canadian government Canada bonds issued in dollars. So it usually goes very, very well.
Okay. And is that, I mean, broadly, can you tell us sort of which areas of the market you're adding to?
So in our Canadian dollar portfolios, so Sri talked about sectors. The other thing we've spent a lot of time on is individual security selection. So we're working with our analysts and traders We're looking at a specific ticker in the 2-year part of the curve, the 3-year part of the curve, fives, tens, and 30s, and we will move things around. So even in the cable telecom sector, 3 to 4 names, you can overweight and underweight those different names on different parts of the curve, and then over time we expect to outperform. So that's one of the ways we're adding alpha as well.
Fantastic. Sri, there's a question here. Are there key reasons to be bullish on fixed income? The case for bonds? Absolutely. Let's dig in there.
Yeah, so it's I would say that yes, fixed income, we'll go back to sort of the old adage that as part of a broader portfolio, fixed income has a role to play. But if you also think about it, it's the same argument we've been making over the last year plus, right? Is that where rates are and where yields are, fixed income is more attractive. You are earning income on the portfolio. Yes, it doesn't look as attractive as when 10-year yields were in Canada and well north of 4% and 5% in the U.S. But at that point in time, you can see fixed income's doing what it's supposed to, right? We've seen positive correlations with equity, or sorry, negative correlations with equities come back. They're providing protection in a portfolio. You're earning anywhere from 3.5% to 4.5% on a bond fund, depending on the specific mandates. And so you can expect over time that when you will roughly earn that yield and that return, especially when you have kind of a range-bound environment. And that yield gives you some cushion against the volatility again, because you're earning some income as things are moving around. And again, we pointed to all the risks currently that exist, and that would bias things to potentially needing to cut rates further if there is continued trade wars and it persists. And so you still have that protection and that upside should rates continue to come down. Unless we see some massive spike in inflation, you're unlikely to see banks be raising rates in this environment. So we do anticipate being more range bound out the curve, and in the front end, there's a thought that rates might come down a little bit further if we continue to see additional cuts and a slowdown in growth.
It's interesting because there's a level of peacefulness, Lee. Though it's within a range, it's the world is pretty volatile in terms of markets across asset classes everywhere right now. Yeah, I guess just a little bit to that sleep at night feeling, and the bolstering of the not correlated with the equity markets, because that is always a concern, especially after sort of 2022 and so on.
I mean, volatility has been very high, both in equities and in fixed income. We were watching intraday rate moves that are pretty substantial, and it depends on the latest tweet, unfortunately. But rates have done what you'd expect them to do. They have provided ballast. They have provided security. Rates are lower than they were a few months ago. We've come down in rate, but it's done what it's supposed to do. And then the other thing, you pointed this out, the bank has scope to keep going. So to the extent that this trade war worsens, then fixed income provides a ballast to your broader portfolio, and the bank has plenty of scope to cut rates, and that would provide ballast.
Sri, with the idea of sort of just debt origination, broadly speaking, in what we think is going to be a more industrializing world. I mean, it's happened already over the last 2 or 3 years, but there is a lot of discussion in Canada that we need to do everything from revisiting pipelines to the interprovincial trade that you mentioned, and there's a fair amount of infrastructure that goes along with that. What would you say that you see on the horizon for sort of massive projects, real either nation building or whatever you want to call it, but there's going to be a need to build? What does that look like in terms of debt origination?
Yeah, I mean, I think that will definitely have to be cognizant of the CapEx requirements of such a strong infrastructure build, and I think the key things to watch for is how a lot of that will get funded. It'd probably be some combination of government and private money going in to build it, is mutually beneficial to both public and private sectors. And so I will say that there is a lot of money looking to go into infrastructure type projects, so the capital is there. It's been a high demand area for investors for a number of years, and it's continuing to grow. So I think that would be welcome to the extent that it's going to be positive projects that will lead to growth, and you can kind of grow yourself into sort of that increased levels of funding and debt requirements. And I think that that's something to be mindful of in terms of what we could see in the bond markets for funding going forward. But I think as long as it's tied to good projects that fuel growth and investment, and that balance sheets are managed appropriately during that, it's something that would probably be welcomed from a growth standpoint in the country.
Okay. Lee, anything to add to that? Then otherwise, I'd just like you to.
Yeah.
Yeah.
I mean, the one thing I would add is that the overall financing rate of those projects will be relatively stable. So, as rates rose, we saw a lot of money coming into fixed income. It was, it was a much better asset class to invest in. And when that happened, we saw corporate spreads tighten because of that. So, if we have a decent economy and growth, it continues to clip along, and rates do go back higher, we would expect the spreads to come in on that debt. The spreads come in tighter on that debt. And then to the extent we see a downturn, then base rates, Government of Canada rates will fall. Maybe the spread will be a little wider than it otherwise would be. But again, we're going to see relatively attractive funding rates for those projects.
Fantastic.
Yeah.
Sri, maybe I'll just ask you to wrap up with a little bit of just where you're overweight, underweight. Just give us. I think you went to sort of the financials and on the corporate side of things, but anything else just to add on terms of positioning?
Yeah, I mean, I think broadly speaking, we have a modest credit overweight, but I think it's worth noting that we're probably at the lowest level of our sort of historical overweight to corporate bonds, just given the uncertainty and the valuation. So you tie in the backdrop of the markets and the economy along with valuations. We've been somewhat cautious, and that positioning has also been focused more on short and intermediate corporates. And we've actually been underweight long credit. And that's largely because when you look at the cushion you have against volatility, it's much more efficient to be in short and intermediate credit. And the offset to that is having longer duration provincial bonds because it's more defensive, and also they've actually underperformed of late because of the concerns around tariffs. And so we do think that longer term, which is always going to be our focus, trying to look through the near term noise and where we see value long term. And so that's kind of how we're positioned. But I would say by and large, the risk in our portfolio is probably at the lowest levels it's been over the last few years, just given the volatility and the uncertainty. And as Lee mentioned earlier, our focus really now is you want to take away the overall market risk because of the volatility. And so we're really focused on some of these individual securities and names that we think have a potential catalyst or a reason to outperform, or they might be more defensive in this volatile market. And that's kind of what we've been focused on of late.
Fantastic to hear what you're doing in the portfolio and kind of an update on how you're seeing things. It seems like you've calmed the waters a little bit for everyone here. Sri Tella and Lee Ormiston, thank you for joining us today.
Thank you.
Thank you.